International Women's Day and highlighting the tremendous impact. Yeah, woohoo! The tremendous impact that women have not only on their communities but also on the economy of Canada. And so I'm really delighted to have this opportunity to introduce a really important speaker today. On behalf of the Board of Directors of Manitoba, thank you for joining us. We are so pleased to host the Bank of Canada today, and it's an honor to welcome the Central Bank's Senior Deputy Governor Carolyn Rogers. I will introduce her in a few minutes, but before I do, I'd like to share a few words on behalf of the Board. With a 92-year legacy as the province's largest and most influential business association, the Manitoba Chambers of Commerce is committed to excellence and service to community, and we are fueled by partnerships and collaboration. It is important for us that we contribute to building a more diverse, inclusive, and vibrant economic future for Manitoba businesses and for all Manitobans. This ethos is rooted in the work we do at the Chambers. While economic competitiveness and workforce have long been a focus for us, we have also advocated for improvements to our health care and to the province's child care framework. In health care, we collaborated with Doctors Manitoba and presented recommendations to government on the recruitment and retention of physicians in rural and northern Manitoba. On childcare, we have emphasized how important it is for childcare to be considered critical infrastructure. An affordable and accessible childcare framework is necessary to support workforce participation and economic growth. We will soon launch the 2023 Climate Action Forum series in collaboration with Novel Futures, the International Institute for Sustainable Development, and the Manitoba Environmental Industries Association. It is our goal to build awareness and capacity among Manitoba's SMEs for enhancing resilience to climate change and achieving carbon reduction. Our mission at the Manitoba Chambers of Commerce is to champion sustainable economic development across the province. To fulfill our mission, we rely on a strong, aligned, supportive chamber network. And together, we explore critical issues and challenges communities face and advocate on behalf of business. The Manitoba Chambers of Commerce has an important role to play as a catalyst for meaningful conversations and connections. We are proud to be able to create opportunities to connect with business leaders, government policymakers, and elected officials, like today's special Bank of Canada luncheon. We are committed to serving members in new and responsive ways, and I believe that represents the very best of what the Manitoba Chambers of Commerce can be, an organization that anticipates, shapes, and embraces change. Speaking of change, we've experienced a lot of it over the past 2.5 years. That might be a bit of an understatement. Record inflation and labor shortages have followed on the heels of a global pandemic. Manitobans have felt the impact of high inflation this past year, including higher prices for groceries, fuel, and rent. Inflation is especially challenging for people on fixed incomes, and it's bad for business. Last year, the Manitoba Chambers of Commerce commissioned Leger to conduct our annual Manitoba Business Outlook survey. It should perhaps come as no surprise that inflation was the #1 concern expressed by businesses. In fact, 3 out of 4 business leaders told us that inflation is the biggest barrier to economic recovery. In terms of actions that businesses are taking to combat inflation, 48% told us they are reducing costs internally. 45% told us they are passing those costs on to customers. 33% say they have delayed making investments in their businesses, and 26% told us they are changing their supply chain structure. There's a little line here that says I have to pause for a second because there's something happening with a webcast. I think that's long enough. So in response to these economic challenges, yesterday, Canada's central bank made its second policy rate decision of 2023. Today, we welcome to Winnipeg, welcome home, the Senior Deputy Governor to deliver the bank's Economic Progress Report and explain the implications of the policy rate decision on business, on the economy, and for Canadians. It's now my sincere honor to introduce our keynote speaker, Carolyn Rogers. Ms. Rogers was appointed Senior Deputy Governor of the Bank of Canada in December 2021 for a 7-year term. Prior to her appointment, she served as Secretary General of the Basel Committee on Banking Supervision. From 2006 to 2019, she was Assistant Superintendent, Regulation Sector at the Office of the Superintendent of Financial Institutions, where she was responsible for policy-related functions, including capital, accounting, and legislation. As we know, she's born in Winnipeg. She's a chartered professional accountant and holds a Bachelor of Arts from Brandon University and a Master's of Business Administration from Queen's. Ms. Rogers was Superintendent and Chief Executive Officer of the Financial Institutions Commission of British Columbia from 2010 to 2016, and she chaired the Canadian Council of Insurance Regulators and the Canadian Credit Union Prudential Supervisors Association. And I dare you all to say that really fast. On behalf of the Manitoba Chambers of Commerce, it is truly an honor to have the Senior Deputy Governor in Winnipeg today to deliver her first speech of 2023. So please join me in welcoming Carolyn Rogers to the stage.
All right. Thank you very much, Alison. I think we could have given you a whole bunch of 4-letter acronyms and you could have done my bio in about a third the time, I think so. But that was very lovely. Thank you. And thanks to the Manitoba Chambers of Commerce and the associates of the Asper School of Business for supporting this event and giving me the chance to be with you today. And thanks to everyone here for choosing to spend your lunch hour with me. J'aimerais aussi saluer les membres de la communauté franco-manitobaine et un merci spécial à Mariette Muller qui contribue beaucoup au travail du conseil d'administration de la banque. Eh? Pretty good. Mariette's helping me learn French. It's a particular pleasure for me to be in Winnipeg. As a few people have said, this is home for me. I still consider this city in this province to be home. I was born here. I grew up here. I attended university here, Manitoba and Brandon University. I think there's people from both. And I started my career here. A shout out to anyone here from the Royal Bank or Assiniboine Credit Union. And I still have a lot of family and friends and former colleagues in Manitoba, so this really does feel like a bit of a homecoming for me. And yesterday was International Women's Day. Happy International Women's Day to everyone in the room. And it was great for me to spend it in Winnipeg, hearing from a very inspiring group of women leaders from across this great province. And today, of course, when I'm done speaking, I'm hoping to hear from you as well. The bank regularly surveys Canadian consumers and businesses as part of our work, but having the chance to be here in a room with people like you and hear directly from you on how your communities and your businesses are making day-to-day economic decisions is very important to us. We know that the decisions we make have a real impact on people. And I do plan to spend some time discussing the bank's decision yesterday to hold interest rates steady and letting you in on our thinking leading up to that decision. But let's start now by setting the scene. I'll begin, of course, with inflation, because that is what we target, and as we just heard, it is the thing on everyone's mind. And we can all agree inflation is still too high. It's come down a bit, but at 5.9%, we have a long way to go to get back to the 2% target. Our monetary policy is working to do just that. Increases in our policy interest rate are starting to slow demand giving supply time to catch up and taking some of the pressure off of prices. We know, though, that adjusting to higher interest rates has been hard for many Canadians. Our policy interest rate is at levels not seen for 15 years. We also know that many Canadians are asking how exactly making their mortgages more expensive while they're still dealing with higher grocery bills will eventually lower inflation and make their lives easier. We're also often asked how raising interest rates is going to solve inflation if it's primarily a global phenomenon. Since it was big global forces, surging commodity prices, and major supply chain disruptions that helped spark inflation in the first place, what can the bank really do about it? These are both very good questions, and I am going to do my very best to try and answer them for you today. I'll explain how high inflation in Canada largely took root due to global forces, but then I'll talk about how inflationary pressure spread in Canada because of strong domestic demand, or in other words, an overheating economy. This is what we've been targeting with higher interest rates. And after that, I'll go over what we're seeing globally and at home to put things in a broader perspective. And then finally, as I mentioned, I'll talk a bit about our decision yesterday. So, without question, one of the biggest drivers of high inflation around the world has been higher commodity prices. When the pandemic struck and the global economy abruptly shut down, many commodity prices plummeted, especially oil, but prices also for natural gas, lumber, and copper all fell. However, some sectors of the economy rebounded very quickly. Housing is a good example. So demand for some related commodities, such as lumber, bounced back really quickly. And then, as things started to open back up, demand and prices for other commodities, such as oil, natural gas, recovered quickly too. But then, in early 2022, Russia's invasion of Ukraine further upended the global economy. The Ukrainian diaspora in Canada is actually the second largest in the world, and Manitoba has the highest concentration of Ukrainian Canadians in the country. And so I know the human toll of this senseless war has been felt here in Manitoba. The economic impacts have also been far-reaching and very damaging. By the middle of last year, global commodity prices, particularly oil and natural gas and wheat, had surged to levels not seen since 2008, just before the financial crisis. And it didn't take long for Canadians to feel the effects. Gas prices soared to well above $2 a litre last summer. I'm sure you all remember that well. And because commodities are key inputs to so many other products, the impact on prices was broad-based. Higher energy prices raised the operating costs of virtually all businesses. They also raised the cost of shipping goods to consumers. And food prices soared too. The war in Ukraine affected the price of grain and of fertilizer. And then weather events in other parts of the world affected the supply of many other crops. And disease restricted the supply of poultry and eggs. So this perfect storm of factors was showing up in Canadian grocery stores by the middle of last year. The other main driver of high inflation around the world has been a combination of disruptions to global supply chains and a spike in demand for durable goods. Like other people around the world, many Canadians upgraded their homes during the pandemic with things like new furniture, appliances, and technology. We couldn't spend on services, things like vacations and restaurants, so all of our spending and the spending of many other people around the world was going into goods. Meanwhile, lockdowns were wreaking havoc on highly integrated global supply chains. Factories were shut down, raw materials were in short supply, and transportation backlogs were piling up. The result was prices for a wide range of goods spiked. So these three global inflationary forces, a spike in commodity prices, a surge in demand for goods, and impaired supply chains, then ran headlong into another element, which was an overheating economy here at home in Canada. Early last year, around this time, we were coming out of the Omicron wave of COVID-19 and what turned out to be the last lockdown. The Canadian economy had become increasingly resilient over the course of the pandemic, weathering each subsequent lockdown a little better than the previous. Canadians were anxious to catch up on the things they missed, like traveling and eating out, and so we saw some of the spending that was going into goods start to shift back to services. And even though Canadian businesses had shown remarkable resilience, adapting to multiple lockdowns, many struggled to keep up with the sudden surge in demand they faced. Supply chain issues were still with us, and staff who had left or been laid off during the pandemic had to be rehired, retrained, or replaced. Our survey of businesses in the first quarter of last year found that 4 in 5 were having trouble meeting the unexpected boost in demand, a record high. This pressure showed up very clearly in the labor market. The number of vacant jobs rose to nearly twice pre-pandemic levels, an obvious sign of widespread labor shortages. Labor is an important input cost for businesses, particularly so in the services sector. So the shortage of available workers, combined with the surge in demand for services, put upward pressure on service prices. In addition, with demand increasingly strong, many businesses began passing higher costs on to their consumers. Price increases became both larger and more frequent than normal. So that's basically how global and domestic forces combined to push inflation in Canada up to 40-year highs. But just as inflation rose around the world, it's now starting to retreat in a somewhat consistent pattern. And just as they were on the way up, commodity prices have so far been a key contributor on the way down. Oil prices have declined by around 35% since last summer, mostly due to an improved outlook for supply. More recently, natural gas prices have also fallen sharply as well, by about 60% since last autumn, largely because of the winter in Northern Hemisphere being warmer than usual. Prices for forestry, metal, agriculture commodities have also all softened. Lower energy prices in particular are translating into lower costs, both for global shipping and for inputs. And finally, global supply chains are also improving. There are fewer bottlenecks that made it so hard for the global supply of commodities and other goods to keep up with demand around the world. Shipping costs and delivery times are both approaching pre-pandemic levels. And monetary policy is doing its job. Central banks around the world have tightened policy by raising interest rates, restraining some of the domestic factors behind inflation in their respective countries. That's resulting in slower growth in global demand overall, especially for durable goods. The Bank of Canada, of course, is no exception. We raised the policy rate 8 consecutive times, starting in March of 2022. Our higher interest rates are starting to slow growth in household spending, particularly in the sectors most sensitive to interest rates. And overall, higher rates are helping to rebalance demand and supply in the Canadian economy. That being said, a broad range of labour market indicators have shown only modest signs of easing to date. Job vacancies have come down a little, but they're still elevated. The unemployment rate is still near historic lows, and many businesses continue to report labour shortages. So, what does this all mean for inflation? Well, as I said at the outset, inflation has eased to 5.9% in January from a high of over 8% last summer. It's still too high, but our most recent forecast in January has it slowing steadily to around 3% in the middle of this year and coming back to the 2% target middle of next year. So the inflation story here in Canada has some symmetry so far. Global and domestic forces combined to drive inflation up, and both will need to retreat further to get us back down to the 2% target. So far I've talked a lot about how Canada's experience had a good deal in common with other countries, but there are also important differences. So let me spend a few minutes comparing where we're at on a few dimensions relative to some of our global counterparts. Our current rate of inflation, while still too high, I have to say that every time I mention inflation, is the second lowest in the G7 advanced economies. Japan is lower at 4%. And momentum in inflation, as measured by the rate of change in prices over 3 months, has also been close to the bottom of the G7 countries. Importantly, service price inflation in Canada has leveled off in recent months, while it has continued to rise in some other countries. These rankings, of course, can move around a little in the coming months, but they're all rankings where being near the bottom is a good thing. Let me now turn to economic performance briefly. Canada has recorded the strongest growth in GDP in the G7 since the tightening cycle began last year. And the International Monetary Fund expects Canada to have the strongest growth in the GDP over the course of 2023 and 2024. That's good news, but it does underscore that our interest rate increases still need to work their way through the economy to ensure that demand cools enough for supply to catch up. Our employment growth has also been very strong compared with most of the G7. We've had the second strongest recovery in jobs and hours worked since the start of the pandemic. We've also had the fastest adult population growth fueled by immigration. And our labour force participation rate for women is at the top of the G7, helped in part by more affordable childcare. More supply of labour is a good thing because it usually means the economy can grow with less inflationary pressure. However, we continue to have one of the lowest rates of productivity in the G7. And productivity growth is important because it helps businesses pay for higher wages. If we continue to see above-average wage growth that we've been seeing in Canada without some pickup in productivity, it will be very difficult to get all the way back down to 2% inflation. Households in Canada are also some of the most indebted in the G7. Our household debt-to-income ratio has been on a generally upward path for almost 3 decades. And high debt typically makes an economy more sensitive to interest rate increases. When it comes to monetary policy, Canada has had one of the most forceful tightening cycles. We were the second major central bank in advanced economies to raise interest rates, and the total increase to our policy rate, 425 basis points, is second only to the U.S. Federal Reserve at 450 basis points. We were also the first to end quantitative easing, and since we began quantitative tightening, our balance sheet has contracted the fastest by more than 20%, complementing the restrictive stance of our policy rate. That's the advantage of having an independent monetary policy. We can get back to our target of 2% inflation in a way that makes sense for us, just as other central banks are doing for their economies. Let me now turn to our decision yesterday and how some of the factors I've just talked about shaped the Governing Council's thinking. As I just mentioned, we raised interest rates forcefully in response to high inflation. And after having front-loaded our policy tightening by doing a lot in less than a year, we said in January that we expected to pause and assess the impact of those moves. And yesterday, we did indeed pause, leaving the policy rate at its current level of 4.5%. It's a conditional pause, though. If economic developments, as we've projected, and inflation comes down as quickly as we forecast in the January Monetary Policy Report, then we shouldn't need to raise interest rates further. But if evidence accumulates suggesting that inflation may not decline in line with our forecast, we are prepared to do more. When we looked at the data since January, we found a bit of a mixed picture. Overall, things unfolded broadly in line with our outlook, but we will need to see more evidence to fully assess whether monetary policy is restricted enough to get us all the way back to the 2% target. Now, let me just unpack a few recent developments and share some insights into what we discussed and how we'll be thinking about monetary policy going forward. I'll start with economic activity. Growth in the fourth quarter of 2022 slowed a little more than expected, coming in flat. With consumption, government spending, and net exports all increasing, the weaker-than-expected GDP was due largely to a slowdown in inventory investment. The data did show that, in general, higher borrowing costs continue to weigh on sectors that are sensitive to interest rates, such as housing. They also showed that business investment has weakened as demand slows both in Canada and abroad. We also talked a lot about the labour market. Job gains in Canada have been surprisingly strong in recent months, and the labour market remains very tight. With weak economic growth for the next couple of quarters, we do expect the tightness in the labour market will ease, and as it does, pressure on wages should come down. You might remember me saying that if strong wage growth isn't accompanied with strong productivity growth, it will be difficult to get back to 2% inflation. Well, we noted the data last week show labour productivity in Canada fell for a third straight quarter, so productivity isn't trending in the right direction so far. We agreed inflation is coming down largely as expected, and there's been a clear momentum shift in goods prices. But we also agreed service price inflation needs to cool further beyond the leveling off we've seen so far. And we'll need to see companies return to more normal pricing behavior. Year over year and 3-month rates of core inflation both need to come down more than they have for inflation to return sustainably to 2%, as will short-term inflation expectations. I talked earlier about the global backdrop, so now I'll just tell you how we looked at that in the context of the decision. So we noted that both the U.S. and Europe near-term outlooks for growth and inflation are now somewhat higher than we expected in January. In particular, labour markets remain tight and core inflation is still high. Since these are our main trading partners, this could point to further inflationary pressure here in Canada. We also noted that a key risk to our projection, an increase in global energy prices, hasn't materialized so far, but China's economy is rebounding as expected now that it has reopened. The strength of China's recovery and the ongoing impact of Russia's war on Ukraine remain key sources of upside risk for commodity prices, including energy. And with inflation still well above our target, we're still more worried about the upside risks. We'll have more to say about all of this in our April forecast. I hope I've given you a sense of how global forces have influenced the growth in prices here at home and how they'll continue to influence inflation going forward. Major economies around the world are highly interconnected, but while we're always thinking globally, we have to act locally. Our monetary policy needs to be both forward-looking and tailored to our Canadian circumstances. On suit la situation de près pour voir comment elle évolue et on tient absolument à ramener l'inflation à 2%. We're watching closely to see how things unfold, and we're committed to getting inflation all the way back to 2% so that Canadians can once again count on price stability and sustainable economic growth. Thank you.
Thank you, Carolyn. Thank you very much. So Carolyn has agreed to take a couple of questions. So we've got a couple of microphones in the audience. You may have heard from her presentation as well that she likes to have to find out what's going on in communities. So this is a tremendous opportunity. Maybe I'll just kind of start it off because I think you did a great job of kind of talking about sort of the process. But I'm always interested, you know, over the course of this past year, the Bank of Canada, as you mentioned, has had to make 8 rate increases. And I'm curious when you talk a little bit about that decision making, take us inside around that table at the Bank of Canada when you're making those decisions in terms of, you know, it must be sort of a give and take in terms of, okay, here's the data we're looking at, here's the influence that we need to make sure that we're looking at. Take us behind the scenes a little bit in terms of how those decisions are made and sort of the debates that must happen around the Bank of Canada table. Yeah, I mean, it's funny because I think in the media it sometimes looks like we kind of show up that morning and have a meeting and then announce a rate increase, but it doesn't work like that. It's quite a long, rigorous process we follow, and it's really the same process for each decision, all 8 decisions. It's a little bit longer for 4 of the 8. On every second decision, we do a full forecast. We publish what we call the Monetary Policy Report, which is our forecast. But I mean, the process really starts with a bunch of different teams across the bank bringing together what we call Case A, kind of our base case forecast. That gets presented to the Governing Council. We go through a bit of a sort of a process of challenge. We ask questions. We might ask them to run some scenarios, do a bit of what-if analysis. They take that away. They'll update that sort of over the course of the next week if additional data comes in.
And then we start going through a process where the governing council, the rate decision body, starts to get sort of different advice from different parts of the bank. We have experts in the international economy, we have experts in the Canadian economy, obviously. We've got some financial stability experts, we've got market people. So we get a variety of views. There's a sort of a challenge process to the base case outlook. And then as we get closer and closer to the decision, the room kind of gets smaller and smaller until it's just governing council. And then we really go through sort of a debate. I would describe it more as a consensus building discussion. We don't, our process is a bit different than the US, for example. We don't vote. We just basically, we talk it through till we get to a consensus. Usually about 24, 48 hours before we're due to announce, we've landed on a decision, and then we go through quite an intense process, sort of thinking through the communication, the press release, and stuff like that.
Right.
Yeah.
One of the things I'm interested in as well, and obviously you're looking at things from a national perspective, but I think when we look at things from a regional perspective, there are certain parts of the country that have performed a lot better than others have as they've sort of come out of the pandemic. And I'm curious in terms of how is it impactful in terms of looking at regional information as well when you're making these sort of national decisions for everyone, that obviously, Manitoba's done well over the last little while in comparison to other jurisdictions. Do we look at things from a regional perspective as well?
Yeah, absolutely. I mean, we have some of our regional staff here with me. We have 2 people from our Calgary office, Alex and Lori. So the bank has offices all across Canada, and a big part of the job of the people in those offices is to be out in the community, talking to businesses, talking to people. Our board actually plays an important role for us too. They're drawn from across Canada, and they give us good intel on their local communities. So, we have kind of an outreach program. We also have more sort of rigorous tools. We have surveys. We publish the result, what's called our Business Outlook Survey. We talk to Canadian consumers on a regular basis. So, yeah, we definitely take in a lot of data from across the country. But, what I would say is the economy has been, there is some differences across the economy, but I mean, inflation is affecting everybody across Canada. Labor markets are tight across Canada. So what we're seeing in right now is there's really more in common than differences. Yeah.
And of course, we do have representation in Manitoba on the Bank of Canada Governing Board.
We do.
Mariette Moulaire, of course, right there up front. And if anyone has the pulse on the Manitoba economy, there's not very many better than Mariette, so we can always have a conversation with her if you want to learn about Bank of Canada monetary policy. Inflation. So let's talk about that just a little bit. So the inflation control target that the bank has sort of set is sort of at 2%. And I'm curious as well, because can you kind of explain to us maybe Canadians could potentially see a change in that inflationary target? I know there's been some, what about an average of between 1 and 3? Could we, if we get closer to 3, could we see some changes in that? So is the Bank of Canada really set on sort of that 2%? And why is that sort of the magic number that you look at?
Yeah, it's important to understand where that number comes from. So it's not a number that the bank sets independently. Framework. Every 5 years. The most recent one was just in 2001. And the way that process works is there's we talk to academics, we talk to economists, and we really get their view on what is the right target and what are the right tools to get to that target. So that's a process we do every 5 years, and then we reach agreement with the government, the federal government at the time, on that framework. So it is a jointly agreed framework. Now, to your question, is 2 the right number? We think it is. There is a lot of experience and research that tells us 2% inflation is a level inflation where it doesn't mess up people's planning, their thinking, businesses can operate. I mean, we heard just in the intro remarks how damaging high inflation is to people's ability to plan and the value of the 2% target.
Whenever you make announcements as well, I love reading The Economists across the country and with the different banks and their sort of take in terms of where the bank went and the sort of the signals that you've provided in that. And I was reading this morning just in terms of on the Winnipeg Free Press in terms of, okay, the announcement was made yesterday, and some of the, it was Stephen Gordon, an economics professor at Laval University.
Oh, yes.
Highest interest rates in the U.S. could attract investment there, weakening the Canadian dollar and raising price of imports for Canada. And so I'm interested because the Federal Reserve is taking a little bit of a different approach, where they're continuing to see increases, and Canada's kind of taken that hold. Yeah. And there is a bit of a concern in terms of, do we need to stay in sort of lockstep with the U.S. on this? So how do you respond to that? That we're a little bit different than the U.S., and you kind of talked about that in terms of some of the measures that we're taking, but how important is, as connected as our economies are, and the potential impact if the U.S. takes a different approach than Canada does?
Yeah, well, absolutely. I did talk about that. The most important thing I would say is our monetary policy is designed to suit our economy here in Canada. But there's no question, the U.S. is our biggest trading partner. They're a big economy, and what happens in their economy will feed into our economy. When it comes to their monetary policy, I think the important thing is to sort of look underneath the decision and see what they're reacting to, and the degree to which that's going to affect our economy. I mean, exchange rates, as you mentioned, are a key channel. We have a floating exchange rate. That's a feature of our monetary policy here in Canada. We don't target the Canadian dollar. We don't target a spread between the Canadian dollar and any other currency. But it is true, if our dollar depreciates, particularly against the currencies of our key trading partners, that means imports coming into the country are more expensive. That can put upward pressure on inflation. If that happens, that'll have to get built into our forecast.
Carolyn, I appreciate you taking the time to join us here this afternoon and talk about monetary policy. And I'd be hesitant if I didn't ask as well. You brought family here today, right?
I do have my family here.
So where's your mom and dad? I believe are here, right? Are they here?
My mom and dad.
Where's your mom and dad?
There, yeah. And my sister.
Oh, there they are. And your sister?
My sister's here too.
Your sister's here too. Did we give her a good seat? I hope.
She's back there. Yeah.
Oh, we stuck her at the back. So when you come back to Winnipeg, what's the one thing you always? Here's where we got to go and visit this place. Is it a restaurant? Is it?
Well. Gee, I don't know. Like, the restaurant scene has changed since I live here, so I usually just go wherever my sister takes me. But the thing that I really associate, if there's sort of one place or one event that I associate with Winnipeg, it's the Folk Festival.
Oh.
And I was looking at we're coming up to the 50-year anniversary, a really good lineup. Yeah. So yeah, no, there's lots to love about Winnipeg. The event that I was at last night was at the Museum for Human Rights. It's just a spectacular place, really, really a gem for this city. So, yeah, it's just great to be back.
Well, I want to thank you for coming back, and at this time I would like to introduce the University of Manitoba as our presenting sponsor for today's event, and I would like to invite Dr. Michael Benarosh to the stage for some comment on behalf of the U of M. Michael.
Okay.